Hey guys, I'm just here with Matthew Kerr, who runs Insider Finance. So those guys looking to do finance deals for small property developments, or you want to refinance your portfolio, pull out some equity and go and buy another property, whether it's in a development property or investment property. So Matthew is a gun in this space, has been involved in this space for a number of years and has done smaller deals and a whole lot of bigger deals as well. So if you're looking at anything sub 1 million, or even if you're over that and you're in the residential space, Matthew is an absolute expert in that. And he's got a number of years of experience that many other brokers cannot compete with. So if you're looking for a really good broker, I definitely would recommend Matthew for those guys who don't have a broker already. But Matthew's got some case studies which will give you an idea on what's possible. So Matthew, I'll hand the reins over to you.
Thank you, Adam. Very kind introduction. Yeah, thanks for the opportunity just to go through a couple of recent case studies that a couple of deals that we've put together recently, which might sort of fit in, hopefully, with a few of your investors. The first one we've got here.
Oh, you've got to make it full screen. We probably should have said that at the start.
All right, let's
try F5.
F5.
I'm pretty sure that's the shortcut. Or is it F4? There we go.
There we go. Thank you, mate.
Truly raw. We didn't even prepare. Well, you did.
Not massive on PowerPoints, but we'll see how we go. No, this one's fairly straightforward as a transaction. It was a single individual that set up a company to purchase a development site, which was a house and land, with the intention of doing a duplex development on this particular site. So the overall transaction included refinancing the existing home loan into a cheaper rate. We did a cash out to cover the 20% deposit plus costs, including some development costs. So that cash out component was also secured to the home. Sorry about that. And then we did the new 80% loan against the property itself. So the owner-occupied property is just in individual names. So we did the cash out transaction against the home. He was able to on-lend that to his newly formed company, which was the purchaser of the new property. But the idea was to access as much cash out against the home as we could, A, because the rate was cheaper against the home, and B, just to have enough in the way of surplus funds just to cover all the on costs for the development, as opposed to having to borrow it under a higher rate against the property itself.
Okay, so just jump back one, or is this lending breakdown still part of it?
Yeah, this is part of it. So just where I've gone into a little bit of detail on each sort of component of it.
You might answer my questions then. I'll let you run through this and then.
Yeah, no, that's okay. The first part of the refinance was just obviously looking at getting a cheaper rate on the existing home loan, which was pretty easy to do. He was stuck with a big bank for quite a period of time. So he was paying 3.75 on the home loan. Hadn't looked at it for years in terms of getting a rate reduction. So we're able to refinance the home loan itself down to 2.14. So that was a simple part of the transaction just to save some dollars.
That was before interest rates went up. The 2.14.
That's pre the 0.25, which is going up today with most banks.
Okay, so that would be what, in the order of 2.3 now %.
Yep. So that one, would have gone to 2.39. So, I mean, the difference in the rate is obviously still going to be the same because the 3.75
would have gone up as well.
But a decent saving there of in excess of $7,000 per year.
That's pretty good.
And the client was just unaware that they were paying overs. They just assumed that their banker was looking after them. And
so
unfortunately,
typical client that's gone from a banker to a broker by the sounds.
Yes, exactly.
Yeah.
And that's we're still seeing that a lot today, even though brokers are writing nearly 70% of all business in the industry. we're still seeing a lot of people that, for whatever reason, are still tied to their own bank and loyal to their own bank. So anyway, it was a nice surprise for this client to get that rate. That second part of the transaction was the cash out component against the home. So with this particular lender, they had unlimited cash out as part of their policy. So some banks will limit the cash out component. You can get to anywhere from 50,000 all the way up to unlimited. Some banks want proof of exactly what you're doing with it. Some don't.
I've experienced that.
Yeah. So yeah, they're all a bit different on how they treat it. Obviously, the beauty of what we do is we monitor whose policy is more flexible. Policies change all the time, so they can go from having unlimited cash out as a policy to a letter from the accountant or financial planner just to say that they've spoken to the client about what they're doing with the money and they're comfortable. Now, accountants and financial planners don't really ever like signing off on letters for banks.
No, they don't.
It's not overly attractive to them. But the idea there was to get as much cash out as we could against the home to get that cheaper rate of the 2.59 as the interest-only variable rate, which is obviously will be going up by 0.25 as well. The beauty of having that facility set up against the home as well is that it can stay there ongoing for the next project. So, when they do the development, sell the property, pay out the loan that's secured to the property that they're selling, the surplus funds can all come back, pay down that 700K facility and leave it there for the next opportunity that comes up. So it's very handy as a way of being a vehicle to get into the next investment and the one after that.
And I'm assuming, not that I'm an accountant, but I'm assuming that the 700,000, because it's used for investment purposes, it's tax deductible, as in the interest is highly likely to be tax deductible because it's used for that. Whereas if it's in their own property, because it's your principal place of residence, that interest isn't tax deductible ultimately, as in the interest on the balance. So if you've got equity in your own property, it's sitting there doing nothing. It's not offsetting any tax while you're earning money.
Correct.
So there's all of that offset saving. So it's not that, what's he paying? So he's paying a measly 2% on the money, but then he can claim that whole 2% as an expense. And offset it against his tax, right?
Exactly right. And it's important when we set it up that we do keep the split between home loan and investment loan. Obviously, the home loan being non-deductible, the investment loan being deductible. Come tax time, much easier. Then you get the statement confirming how much interest you paid on that 700K facility. That goes into your accountant to obviously claim as part of the cost of that project. And we sort of find there's no issue. I mean, obviously the ownership of the home is generally just in individual names. So if we set up that example 700K loan in individual names, the accountant will generally be able to on-lend that to the company that's investing in the new property. So obviously with anything taxation related, seek advice from your accountant. But that particular loan doesn't actually have to be in the company name that's doing the investment. It can be on lent to that company. So that was the cash out component. And obviously the purchase component here was just the 80% loan secured to the new property. This particular client is a self-employed builder who has seen a lot of growth in the last few years. So his tax returns for 20 and 21 were quite good. 2021 saw a fairly big increase on 2020. This particular tax year, he's doing about double. So we couldn't get him over the line just based on 2021 figures. So we were able to do a light doc facility, which is, the old school low doc, except you do need to provide a bit more information around income. So with his BAS statements for this particular year, and also profit loss just signed off by the accountant, we were able to get the loan over the line. Unfortunately, due to that type of product, the rate is a bit higher. So the rate against that purchase loan was 3.75. But
that's still low in my books.
Still cheap money.
Yeah.
The money that he had left over from that $700,000 facility. So after he put in his 20% deposit, covered a few costs initially at the acquisition.
So just to clarify, his purchase price was 1.43 million on that house that you showed us on the previous slide.
That's right, mate. I'll just flick to the next one.
And then hang on. Go back.
Oh,
back.
hang on.
Other way. Left arrow. Yeah, so go back one more. Just to recap, so the purchase price of that property is 1.43 million.
1.43, that's right.
He got 700,000 from his existing house to put into this property.
Correct. Yep.
And that covered the deposit. So he put in 20% deposit, is that right?
Correct, yes. Yep.
Okay, so that takes it to about 280 plus stamp duty. So call it 350 for round numbers.
Yeah. I'll just
is that in the next slide? Is that coming?
Yeah, this one here is a bit of a breakdown.
Apologies.
Yeah, no, you're right.
You've already done it. I should have looked when you.
No, that's fine. It's just yeah. So the breakdown: 1.43 is the purchase price, stamps and legals 70 grand, total 1.5.
Yeah.
So the 80% facility secured to the new property is that 1.144. So that's the loan that was at the 3.75%.
Yeah, gotcha.
So sorry, the funds.
I was pretty close with 350.
Very close.
It was pretty good.
Educated guess. But so 356 is how much he had to draw at purchase stage. So he still got 344 available out of that 700K facility, just to go towards the development costs, whether it's infrastructure charges initially, design and that type of thing. At least he's got a float to work with there.
Yeah, and he's got that's a pretty big float on a project of that size.
It is. It was, for him, it was more about how much can we get access to at this particular point. And just based on the valuation of his property, the fact that values have gone up so much in the last 12 months, he thought, look, I may as well grab that cash while I know it's available, because whilst this particular project is only fairly small, he's got ideas of doing bigger projects as he goes forward. So just having access to that bigger lump of cash was beneficial for him.
Yeah, especially when the purse strings tighten, when we see like quantitative easing and they. The banks start to pull back on investment loans, that loan isn't affected by any of that, is it? Because it's already set up.
It's already set up. It's just a standard residential investment loan. You can have an offset account against it. It's not subject to annual review or anything like that, like a commercial facility may be. So it's there.
Yeah, and he can use that for whatever he wants. He can go buy a car. Not that that's a smart thing to do, but if he needed a car, it's 2% finance.
Absolutely.
Boat, caravan, but for the purposes of this, you want to make it work, the money work for you. So he could literally put down a deposit on another property or invest that money somewhere else at 10 or 20% return while he's paying 2%.
Yep, most definitely. And
the bank's not going to ask where he's putting it, are they?
No, once the loan is established, they really don't have any control over what you do with it, for what purpose you use it for. So it's assessed under their policy at the time you make an application. Once the facility is set up, you can do with it as you please. So, and I guess it's part of the reason some banks still want evidence of what you are doing sometimes with a cash out sort of facility, because without going into history too much, pre sort of around the GFC time, banks were sort of lending money fairly freely on cash out terms.
Yeah.
and people were making poor investments, and then actually coming back to the banks to say you shouldn't have given me that loan without sort of understanding exactly what I was going to do with it, and actually getting money repaid to them because of that. So things really did tighten up. How, the interesting thing is how some banks can interpret responsible lending one way, and then other banks, interpret it a different way.
Yeah.
So where a bank can say we've got unlimited cash out up to 80%, you just need to say it's for personal investment. How they can get away with that, whereas other banks need, evidence. It's a bit confusing for people, but
so
the key,
I was just going to say, I know some people have said, I'll just go to my banker and I'll tell him, I want cash out.
Yeah.
And, life's good. And then they come back and say, I went to my banker, I told him I was buying an investment property, he wouldn't give me the money.
Yeah.
And the reason is that people have told them the wrong thing. And then the bankers just looked at the book and the policy and gone, oh, we need X, Y, Z. And
yeah, absolutely.
I actually have had someone invest with me who had quite a substantial property portfolio, and he'd only dealt with his banker, and his banker wouldn't even give him like $500,000 out on $4 million of equity. He wanted to know where it was going, and he wanted the loan secured, and he wanted to just mix it all up. And all his properties were a mess because they were all with the one bank, and so it even happens at the top end, which I was very shocked at.
Yeah, absolutely. Yeah. Look, it's pretty rare you find someone who's with a major bank who's got a personal banker that's happy these days. The private banker or personal banker offering, I think, has changed quite significantly. So where a banker might have used to had 200 clients under their portfolio, that can be, 4 times that amount now. So the service level just isn't there. And I think it's almost like they're falling on their sword a little bit, knowing that brokers, do a lot of their business now. And, for us, it makes no difference to us how someone has their debt secured. We're not looking to cross secure everyone as a bank normally would to put themselves in a stronger position. It's a better outcome for the client generally.
Yeah. And I suppose from your point of view, if you don't write loans, you don't get paid. Is the other way. So you're performance based. So you have an incentive to write the loan, whereas a banker, I know just some other people, acquaintances and friends that used to work for banks, and they took away all their bonuses a number of years ago. They had all these bonuses that they had when they wrote so many loans, and they ended up taking them away. And I found all the good people that were writing lots of loans, they ended up leaving and either being a broker. One of my friends who wrote $50 million of loans for one of the major banks, he ended up starting his own financial planning practice.
Okay.
Just because they stopped paying him bonuses. He told me he was due like 100,000 in bonuses one year, and they didn't pay it. So there's no performance.
One of those, and it's one of those outcomes from the Royal Commission where they thought those kinds of changes were beneficial to the consumer. And I think what you've just described there is very true, in that there's no major incentive for a banker internally to go over and above to get a deal done for a client, because it's not tied to their remuneration. I think that's a better outcome for a consumer if it is in their best interest to get your deal approved. So
yes, I completely agree.
But we don't feed the kids unless we get loans approved. So
yes, and you got staff to pay as well. You have people helping you write loans.
Exactly. So I think it's the right way to go about it. But certainly a benefit that we've got obviously over a banker is that we've got 65 lenders on our panel. So multitude of different policies and options available. So if you don't fit in the square box, we'll find someone that will generally be able to assist. Yeah,
awesome. Okay, this scenario, this case study that you've just described to us, I would say the majority of people I talk to are in this space. They already own their own property or multiple properties.
Yeah.
And they either have tapped out serviceability wise, or they just don't know how to access the cash, or a combination of both. So do you have a case study where you can put this same sort of thing, structure in place if somebody is tapped out with serviceability, or, you know, their stuff is a mess kind of thing?
Yep.
Is that just as simple, or do you have another case study around that?
Well, I've actually, the next one I've got is probably a pretty good example. I'll just flick through.
Oh, let's finish off this one first.
Okay. All right. I'll just quickly go back. Oops. So that was the breakdown. We had 344 left over out of that 700K facility. These guys are now at the stage where we're looking at getting the construction loans set up. So they're just waiting on a fixed price contract for the bill at this point. So just a couple of things on that. With a duplex, obviously 2 properties being constructed on the one title. That will fit with most standard residential policies with most lenders. So that will generally, you know, between sort of 2 and 4, we can get set under a normal residential style loan, which is obviously going to be cheaper to set up, cheaper as an interest rate, cheaper to get out. So with these guys, we will probably do a light dock construction loan to get that construction funding set up.
So they get it at 3.75% for the whole construction facility.
Correct.
And what's the gearing? What's the loan to value ratio? Probably 80% on completion. Is that
it's going to be just at 80%. He's bought the property very recently, so I don't suspect that we're going to see any growth in the existing property between now and when we get that on completion valuation done. So it's going to be 80% on cost. So he's got obviously plenty left over with that 344 to cover his 20% construction costs. He's going to be building for about 1.2.
Okay, so he's all in for what, 1.7 or 1.8. So he's got to chip in probably all of that 350 by the sounds.
Well, the about 240 of it at construction time. So he's got about 100K flow.
Oh yeah, of course, because he's already used the other bit for the deposit. Which I forgot about.
Correct.
Okay.
So he's still pretty comfortable there, and he's got a bit of cash on the side if push comes to shove. But so that kind of construction loan, the easiest way to think about it is it's just the same as building a house. Just a normal construction loan for a house for an investor. Just happens to be 2 duplex. Because under that type of product, as I say there, the benefits are lower setup costs, normal residential interest rates, no requirement for pre-sales, which is advantageous, and it gives them the ability to hold and rent if the market flattens. So that just means it's a normal loan, interest only. In the assessment of it, we include proposed rent for the finished product that we can include as income. And then look, if the properties get finished, the market's not conducive to getting what they need, they can at least rent the 2 properties out, hold them until a better time to sell. So
okay, and under that scenario, as like a fallback position, because I have been in markets where it's been better to hold off until the market's recovering. What's their cash burn? Is it like neutrally geared? Is their rental return, does it cover all of their expenses and their interest? Can they hold it without outlaying any capital, or is it actually positively geared?
On this one, I actually did do those sums.
I've hit you with
No, sorry, I did the sums for the next one that I was going to show you. With this one, the answer, and we can do some quick sums. So the estimate rent on the finished products were $900 a week.
Okay.
So that comes to, we'll just work it on a monthly basis. So from an income perspective, $7,800 a month in rent, less the agent's fee, obviously.
I normally use 80% as a net figure. That's what a lot of banks use, just as a
Sure, yes,
as a round. Some of them use 85, but I like to be a bit safe.
Yeah, cool. So that'd be 6,240. Now, the interest, assuming that the 700 was fully drawn, so we'd have 1144. Sorry, just quick numbers. 3575. 700. And then the construction split would be 960, which is the 80% of.
I'll put you on the spot here.
I like it. So 3, yeah, so it's not going to quite be neutral. So interest cost 8,085 per month.
Okay, so, and you're at 6,600. So about.
Well, the 80% figure of the rent would be 6,240.
Oh, okay.
So, which I think is a good guide. So,
couple of thousand a month.
Yeah, 1,500
worst
a month.
Case. I mean that's obviously worst case.
Yeah, 360 a week.
You know, even in flat markets, properties still sell. So even if he just sold one and kept one, if he sold one and kept one, I'm sure it would be positive.
Yes,
quite positive.
Definitely.
And he's probably, you know, he's not doing this for fun, so he's probably got 20 or 30% margin in the project.
Correct.
So
yeah.
So even if he has to hold both and the market flatlines, he's probably still sitting on what, $500,000 of equity in those properties.
That's pretty well what his sums came to. Yeah.
That he manufactured.
Correct. So which is pretty good. And
he could probably even redraw that capital and go again, right? As in redraw that equity if he wanted to.
Exactly.
And hold the properties.
Exactly right. Because, you know, if he sells one, obviously once the project is complete, he's done the strata titling. If he sells one, we can just revalue the remaining property. And as long as he's sitting below 80%, you know, after that sale, he can hold any surplus cash that he may have at that point. So
you can do the whole thing again, right? The cash out based on that property. Yeah. So even if he had a cash burn, just say for example, even if he had a cash burn on the property and it was negatively geared, he would still be able to redraw a facility and even just use the facility to pay out the interest. And then, you know, if the market goes up by 20% in the next few years, then he, you know, it might have cost him, say, 20 or 30,000 to hold, but if the market goes up by 300, 400,000, as we've seen, and in some areas, I believe it will keep going, which, irrespective of what the banks are saying, there's still some markets that are going to boom.
For sure. No, but that's a very real option. You know, if you did want to just sell one, just to de-risk it a bit, and hold the other one, it's a pretty simple process to hang on to some cash and cover that funding cost. I mean,
he's got multiple options. Multiple exit strategies.
Correct. Yep.
All right, we'll jump to the next one. You've got 3 you mentioned.